and right now it's kept the bulls away.
All right, Reema, thanks a lot for summing up everything that's going on in the global markets for us. But in fact, staying with the global markets, let's also invite our first guest on the show. We're joined by Rajat Bhattacharya, who's a senior investment strategist at Standard Chartered, to take some questions on this and how the global markets are likely to move from here as well. Rajat, thanks a lot for joining us. This is Pavitra. You know, I'll come to the Fed rate hikes, all of that in a bit. But first, just on this news that we got overnight on SVB, how do you read that? You know, anytime there's some news flow of this variety that comes out of the financials, it's just heightened nervousness, right, that we see in the markets. Do you think the pressure on the banking pack is likely to continue because of what we've seen here?
Morning, Pavitra. Thanks for inviting me. To be honest, these shouldn't be surprising us. What we've been saying in your platform and elsewhere is that when rates rise so sharply, this has been the second steepest Fed rate hike cycle in history. When it rises that much, accidents are waiting to happen. And that is why, since the start of the year, we've been positioned very, very cautiously, defensively. So, in the specific case here, I mean, we are looking close to towards that. These are small banks. And we know that the large banks, large US banks, are very well capitalized. The Fed's focus has always been on the large banks. So they are secure in that sense. But we need to watch the contagion effect, right? So the contagion effect within the small banking sector, if that spreads towards the medium-sized banks. The large banks, as I said, I mean, are very well capitalized.
Right. Rajat, a lot is happening in the US, the global market, so to say, because on the one hand, the Fed is now talking up its, or it's increasing the tone towards hawkishness once again. Secondly, we have some data which is due with regards to the labor markets, etc. And thirdly, with all these accidents taking place, so to say, I'm sure there could be some more as well, as Uday Kotak has pointed out. There are offsetting cues. What does the Fed do in a situation like that? And what are your own expectations? Is it going to be a 25 basis points hike, a 30 basis points hike, a 50 basis points hike? Where do they stop? Where do your terminal rate expectations go from here?
Yeah, that was well explained, I must say. What happens is now there's a tug of war, right? So we were, before what happened last night, I think the market was expecting a 50 basis point hike because of the strong data, including inflation and activity data in the US. And especially after what Powell said, that he was considering a step up again in the pace of rate hikes. But I think after what happened last night and in the markets, they're going to be cautious. So if I were to put my money on it, basically it's around 25 basis points is where they will stick to for now. But as you said, tonight's non-farm payrolls is critical. Next week's CPI data is critical. Those are the two data points that Powell clearly said he's looking forward to before they make a decision. So depending on how hot these two data are, and as the reporter earlier mentioned, the job market has been very tight for long. If that tightness continues, they might still go for a 50 basis point hike. But this market reaction that is already happening makes the case for a steady pace of 25 basis points, and then they will see, they will watch the data closely.
So Rajat, what you're saying is 48 hours prior, you were anticipating a 50 basis points rate hike, and now you've toned it down to 25 basis points?
Well, we don't change day to day, but our base case, I must say, it has been 25 basis points before. Okay. But based on the data and what Powell said, the market and along with us, I mean, we had raised our expectation. All of us had raised our expectation, but this throws a spanner to that, right? So I am looking very closely to the two data points that I mentioned, CPI data and the non-farm payrolls tonight, to decide. And the Fed, I'm sure, is also looking towards that.
CPI inflation print comes out on 14th of March, and then the FOMC meet is on 21st and 22nd of March. So basically, the decision comes out 22nd March. US time, so Indian markets react only on the 23rd. And the Fed goes into a silent period, right? They won't be making any statements after Saturday. So they go into that quiet period. Rajat, so you're very cautious in the global markets as things currently stand. What about India?
Yeah, India, I mean, and the broader Asia sphere, it has been our, area of preference since the start of the year. As I said, we were defensively positioned getting into this year. We were skeptical about this big rally that was happening in US equity markets since October, November. And we were asking people in January to fade the rally in US and European markets and move some of it towards Asia. Within that, India, of course, is a bit expensive. So whereas China was very cheap in valuations, so we're asking people to focus towards Asia, but within that, look towards China. What we heard over the last 1 week in the China's Congress, actually, they reiterated their need to stimulate the economy, the domestic economy, through consumption. And that's beneficial for the consumption-driven sectors in China. So again, there's been a rally there, and then there's been a consolidation in Chinese equities. It's a good opportunity for people looking at Asia to really focus on some of those targeted sectors, consumer-focused sectors like consumer discretionary or communication services, which are going to benefit from these policy measures that China has announced. And those are the areas to focus. In India, we would actually prefer bonds over equities because of the reasons cited. I mean, the RBI has raised rates. We are closer to that peak in rates in India, and it's a great time to buy bonds. So if you're underweight there, you should be looking at bonds right now.
Okay, got that. Rajat, one quick question. What we're seeing play out with the dollar, A, do you think this move is likely to sustain? And B, if it does, then would you look at commodities in this context?
So the dollar benefits, the dollar smile, so to speak, benefits in terms of prices. So if this, this problem that is emanating from the U.S. markets in terms of the small banks, this could benefit the dollar. Dollar has, reversed its recent losses, and in the last few weeks it's been gaining, along with the risk-off sentiment. So risk-off sentiment should prop up the dollar, I would say, for a while.
Well, your sectoral preference right now is bonds over equities. But if one was to be in equities, what places do you think would provide some sort of safety and maybe at least as much returns as bonds, if not more?
It's going to be challenging for equities to beat bonds this year. Where bond yields are, where the rates are, we are closer to the peak in bond yields and rates than we are closer to the bottom in equity prices. Equity, prices are not estimating a downturn, right? We're expecting a recession in the US and Europe, for instance, and the consensus earnings estimates there are not pricing that in, nowhere near. So to your question on where in equities, within equities, while we prefer bonds over equities, in equities we prefer Asia ex Japan, and within Asia ex Japan we prefer places like China, which is still underpriced globally.
Rajat, we'll leave it at that. Thank you very much for joining in. The view coming in from Standard Chart. Get into a break. On the other side, we'll continue our focus in the markets. Rohit Srivastava of IndiaCharts.com joins in next.